Should we start with property or banks? What do you think is more important?
Actually, property today is the most important thing for China economy, right?
Okay. Yeah. Okay. So, what are your assumptions in the housing market? Let's start there.
So first, regarding to the overall housing market, I think the consensus is already that for China, the property sales may not go back to the yesterday, right? It will probably continue to decline due to the trend of the population, the birth ratio, and the marriage. So I think that's already the consensus today. But the key point today is that whether, for example, whether Country Garden will default on its debt, and whether it will be a like hard landing or a relatively soft landing.
So, I mean, how does it move the needle here? I mean, JP Morgan is suggesting that the annualized rate on new mortgages stands at 4.18%. That's about, what, 60 basis points lower than outstanding borrowings. So it does make it move the dial there. But does it do enough to perhaps get people spending, which the Chinese economy needs? But then again, the banks are not going to like this, are they?
Banks doesn't want to lower their net interest margin, of course, but I think at this moment it's not up to them, right? For China, the government trying to lower both the loan yield and also the deposit yield in order to like push people to either like more investment or like to investment into property, buy more property or buy like bank wealth management products. On the other hand, is that for banks, because if we are talking about relatively longer run, today if the property market continue to collapse, then it will has a higher chance to trigger the systemic risk, which will be also very harmful for China banks. So at this moment, I actually think that to lower the rates is a better choice.
And what are you thinking in terms of net interest margins now? I mean, you know, how much pressure could we see in that, and what does it mean for into a profitability perspective for these lenders?
Gotcha. So first, regarding to the net interest margin, we see that banks going to like cut the loan yield for existing mortgage. For that part, if China bank, we estimate that a 10 base point cut in the mortgage will result in around like 1 base point decline in net interest margin. Second is that we see that banks are cutting yield for all kinds of loans. For the like small business loans, we see banks loan yield has already been lower than 3%. For some specific borrowers, and also for like consumption loan and a credit card, all kinds of loans yield we see they are declining. So at this moment, we expect that the net interest margin continue to decline at least until second quarter next year.
Just to follow up on the banks before we move on and pivot back to property. So the banking sector this week has underperformed the market, and I would imagine the market's looking at that and okay, they're being called for national service.
Yeah.
The question on whether the payouts are at risk, what's the answer to the question? Because if you're looking at lower profitability, but also the recipients of those dividends are also parts of the government who would then benefit from that money in terms of providing fiscal support, are those payouts at risk? And is that something that investors can still play, the dividend plays in the Chinese banking sector?
That's a very good question, but very, very challenging as well. So in short term, we think that most investors will look at more on the profitability side, right? Okay. So for China banks, like definitely lower net interest margin, more social responsibility. So actually, that's also one of the reasons that it makes them like underperform. But in a relatively longer run, as we just mentioned, like we see higher chance of like systemic risk. So helping the economy and also helping like both the local governments and also the developers will help banks to like being relatively safe regarding to like in the relatively long term.